What's up, everyone? Welcome to the Sunday macro wrap up for Sunday, April 27th. This is the last Sunday macro wrap up for April. Seems like April has been a pretty long month, but we do have a lot to cover here, so we can go ahead and get right into it. For those who are joining from our social media accounts, welcome. The way that these Sunday macro wrap ups work is that they're each an hour to an hour and a half long. The first 30 minutes are streamed online for those who are on our socials. And then the last 30 to 45 minutes is reserved for those in our membership groups in order to ask questions, as well as we go over actionable ideas. And so you can think of this first 30 minutes as us going through, some of the data that we saw last week, what we can see coming up this week here. And then if you do want to tune in for what we're talking about in terms of actionable ideas and things that we're seeing on positioning, then I would encourage you guys to go ahead and go to the link in my bio where you can start your 7-day free trial of our macro investing community. And you can just join it real quick and come on in here and join the discussion. But anyway, here, getting right into it, we're seeing a lot of headlines right now, and as well as we're seeing a shift in the immediate term from a lot of retail investors on, is the bottom in? And of course, this is a question that isn't just, the question of the week this week. It tends to be the question of the week every single time, we're in a bear market, so to speak. And so just to remind people, just on March 20th, so at the end of March, we saw, similar call outs, right? And so just like during the end of March, what we want to do is we want to remain patient and not, force us to try and call bottoms in the market, because we really don't know when the official bottom is going to be until in hindsight, right? And so the best thing to do is to just risk manage and pay attention to the differences between what the financial markets are telling us versus what the macro data is also saying to us. And there have been some interesting developments within the macro data where, on the surface, it seems like it could be, let's see. Can you hear me now? All right, great. Yeah, so what I was saying is that, we have to make sure that we are paying attention to both what the financial markets are saying and as well as what the macro data is saying. There's some data that we're going to be going over shortly here that is suggesting that you could see a rebound in growth, but you really want to be cautious that it's not just, some type of fake out reaction, right? And so we're going to be going over all that and more here in the Sunday macro wrap up. So let's go ahead and get right into it here. All right. So taking a look at the S&P 500, obviously pretty strong moves over the past couple of weeks ever since it bottomed around April 9th. And, that was right around the time April 9th should be, a day that you should have, marked on your charts or in your notebook, because that was the day that Trump had released the 90-day extension, or the, I guess, the 90-day pause of his tariff actions towards the rest of the countries except for China, right? So he wanted to really narrow down China. And since then, really, we've had almost like a relief bounce. But when just looking at the charts, pretend like you don't even look at the news. And really, that's what you should be doing, not really looking at the news too much. But you can see that this move here is on lower volume, similar to, what we saw back towards the end of March here, right? You had a similar drop off in volume on this bounce here. And so that's, in a nutshell, what we want to be cautious when we notice these bearish divergences here. And right now I'm looking at the S&P 500 E-mini futures just to get an outlook of, because this opens up every single Sunday at 6 p.m. But yeah, the main thing is what we're seeing is this bearish divergence here between price and volume. When we take a look at volatility, one of the things that we like to pay attention to is 30-day volatility, 30-day realized volatility versus 90-day realized volatility. And both of those continue to accelerate higher, which is bearish typically for the underlying asset. Another thing that we want to pay attention to is the volatility index of the S&P 500, which ever since Wednesday, it's had 3 consecutive closes below 30, which is something that, my team and I have been, paying attention to. And so, now this doesn't mean that you just want to go long stocks. I mean, even if you were trying to be, bullish and try and buy some stocks, you wouldn't do it while volatility had a large consecutive down move, right? So you would want to be cautious for some type of bounce here in the VIX, whether or not you're bullish or bearish on the market. Even though my team and I, we are bearish on the market currently. It's not us, it's our model that is currently bearish on the S&P. And so we definitely want to be paying attention to the VIX. Really, the main thing, the main opportunities from last week was, we had a large correction in gold. And so that was really the largest bullish asset that had a decent correction. So not only that, but gold miners as well. And, my team and I were highlighting that in our communities. One thing that we also like to pay attention to is the yield curve, right? And so last week we had a large flattening, right? So if we go to Monday the 21st until Friday the 25th, so this is when the yield curve comes down like this, that is considered a flattening. And so one thing that I like to look at is, how is this flattening characterized? Because you have 4 different scenarios with the yield curve. You have flattening and you have steepening, but there's 2 different types of each. And so it gives you 4 different scenarios. And so as you can see here, we have the yield curve in purple with this marked at the beginning of the week on Monday, April 21st. And as you can see, we have in red here the 10-year U.S. government bond yield, which came down about 3.64%. And then you have the 2-year U.S. government bond yield, which remained relatively flat, slightly down about 35 basis points. So what that means is that the long-term yields fell faster than short-term yields, and that is what's called a bull flattening. Okay. Now, typically during bull flattening, when you take a look at the actual bond prices, that is when longer duration bonds, bond prices rise faster than short duration bond prices. And so what's interesting, though, is that you continue to have, bearish dollar. And we also had a sell-off in gold, which isn't typically what you see when you have a bull flattening effect. Well, looking at last week, we did have a bounce in the dollar. Still, the dollar still remains in bearish trend. And so, it is just interesting how we are having a bounce here on a bull flattening when typically throughout 2023 and 2024, we had rallies on what's called a bear steepening, which is when long-term yields rise faster than short-term yields. And so it's definitely interesting to see, that dynamic here. Now, taking a look at some of the other data that we like to look at, such as U.S. oil, that continues to have a bounce, still remains in bearish trend, and is still signaling, global demand slowing. But contrary to that, we had a large acceleration or reacceleration in copper. So when you look at the CRB commodity index, lots of commodities having a bounce, and not just commodities, but also with Bitcoin as well. Bitcoin had a large, bounce from that April 9th announcement from Trump and the 90-day extension. You saw bounces in the Eurozone, international equities, China, things like that, as well as the mega caps. But as we mentioned before, even with these bounces, the S&P 500 still remains in a bearish trend. And so, especially on these bounces, this is exactly where you do not want to chase green candles, right? That's one thing that my team and I really like to emphasize is don't chase bear bounces. And even if this does turn into something where this continues up higher, you would still want that confirmation on accelerating volume, which is not what we're seeing right now. And so again, we're not calling for a bottom. We're not calling for, it's going to crash from here. We're just saying that with the setup that we're currently seeing, you do not want to just emotionally chase these. And so yeah, that's specifically what we are seeing here. Getting into some of the macro highlights that we saw last week, it was a pretty quiet week. Really, the main things that we got were flash manufacturing and services PMI, which was pretty interesting. We continue to see a rebound in manufacturing, but a slowdown in services, which is really something that we haven't seen since 2022. Really, during 2023 and 2024, you had manufacturing weaken, but you had the services sector continue to remain resilient. And so, with the United States being a services-based economy, 70% of our consumption is through services, not manufacturing. That's definitely something that you have to consider as we start to see now services start to fade a little bit. We got a chance to take a look at new numbers for the leading economic index from the conference board. That isn't screaming recession at all, but it is having a slight deceleration. When breaking down the different components, what we can see is that the main contributors were ISM new orders, right? So that's a combination of both services as well as manufacturing. And then consumer expectations of business conditions, along with a not as strong S&P 500 metric. Really, over the past couple of years, the S&P 500 metric of the LEI, the leading economic index, was carrying this through. And so with this being weaker, you're starting to see a little bit of a slower bounce. And then really the large strength has been average weekly hours in manufacturing. So the labor market has remained resilient there. And when you take a look at initial jobless claims and continuing jobless claims, we're really not seeing any type of super concerns, even though it is a lot more looser. Is that correct grammar? I'm not sure. It's a lot more loose than of last year, but really what the Fed and what everyone is focused on is on inflation. And we'll get to that here momentarily, but going through some of the other metrics from last week, we got the Richmond Fed manufacturing survey that continued to slow, and that remains in contractionary territory when both looking at the composite as well as new orders. When you break that down, you can see that inventories are rising, new orders are falling, and then you're also starting to see a little bit of weakness in the employment part of this survey, and then prices are just going crazy right now. As we saw in the weeks leading up to the April 2nd announcement of Liberation Day, I heard some economists call it obliteration day because that was when the market really tanked from there. But I even have some friends who are in the manufacturing areas, as well as builders, as well as HVAC. All their prices are going up right now. And the real question is, are those manufacturers, producers, as well as businesses, are they going to be able to successfully pass on those price increases to the consumer, or is the consumer just going to have to eat it, but also start to severely contract their consumption levels in order to make up for these large rising prices? That is the main question, and that is part of the reason why Jerome Powell gets on TV and he talks about them being uncertain about how the reaction is going to be with these tariffs. And so in the real data, just from my anecdotal talking to friends who are in the actual industry, they are all saying that prices are increasing. And so yeah, we're going to see in the next coming months here if those price increases are going to be successfully transferred over to the consumer, or if the consumer is basically going to say, like, you know what, I'm tapped out. I really can't, be priced, or I can't be spending that much anymore. Moving on, we got the flash PMIs for both the manufacturing as well as services. If I zoom in here, we can basically see more of the same of slight rebounds, but still mostly in contractionary territory with manufacturing, and then a continued slowdown in the services sector. This was another data point from last week. Existing home sales contracted for the third month in a row, back down to levels that were pretty consistent over the past couple of years. And it completely reversed all of the optimism from the October numbers to December of 2024. Again, another just data point saying that the consumer is being very cautious right here. Now, we see that in the updated consumer confidence numbers. These were already printed earlier in the month, but this was the second revision. Not much of a change there, as well as there wasn't much of a change from the inflation expectations from consumers, which remain very much elevated and in fear that inflation is going to go up. Now, what's interesting about, when taking a look at inflation here, let me see if I have it here. All right, so when we take a look at the Cleveland Fed's inflation nowcast, we can see that, they still have inflation coming down from here. And so, this gets updated on a daily basis throughout, each week. And looking at the March 2025 numbers, we already received the March data for CPI and core CPI, which came in at 2.41% and 2.81% respectively. And they have it in April, core CPI going from 2.81 to 2.76, headline CPI going from 2.41 to 2.35, and then the PCE, core PCE numbers come out this week actually, and they even have those numbers, coming down from where they're at currently. And so they have 2.19 and 2.54 for PCE and core PCE, respectively. When we take a look at the most recent numbers, we have headlines PCE at 2.53%. And so going from 2.53 to 2.19, that is a very large deceleration. And then with core PCE, that had a 1 month acceleration from January to February at 2.78%. And they have that coming down from 2.78 to 2.54, and then continuing a deceleration further once we get the April data that gets reported in a couple weeks in May. And so the Cleveland Fed has inflation coming down. We're seeing oil prices come down. We have seen a large rebound in commodity prices, but that's still, a smaller part of what we see. And, really we're just continuing to see slowdowns in some of the larger components of these inflation metrics, such as housing, services, things like that, energy. And so, what I'm trying to say here is that there's a little bit of a difference between what the consumer is expecting versus what, the data is actually suggesting, which is inflation will continue to ease from here, not rise, because there's always a difference between inflation and the prices that we pay, right? So inflation talks about the rate of increases in prices. And so they're related, but not the same thing. And so we could continue to see, and we have that as well for our team, that inflation will continue to come down from here. All right. So some of the more optimistic data points that people have been pointing out is that the financial stress index went back down into negative territory, which really that's a positive development. As this number decelerates into further narrow territory, that's typically meaning that there isn't any financial stress in the markets. And that's not necessarily what we've been saying either. We haven't really seen too much of an increased stress level in the financial markets, even though it did come above that 0 point for a little bit there for the first couple weeks of April. And we also saw credit spreads widening, which also have came down a little bit, but not too much on that front. What is interesting though, and I saw some other people point this out, is that bank credit had a very large acceleration in April from pretty much from where it was at the end of March there. We now are at new local highs for bank credit. And a lot of people were pointing out like, hey, bank credit is continuing to accelerate from here. That's actually positive for the financial markets, which could be yes or no, but just like anything, you have to read into the context in which it's accelerating versus decelerating. And so what you could see right now is that, similar to what we saw, I'm not saying that we're heading into a recession, but if people have to rely more and more on, credit cards as well as taking out loans in order to cover for things, businesses as well, then that's actually a sign of stress within consumption. And so with this large acceleration here, you have to, it's not necessarily the steady uptrend that we saw pretty much throughout the entire year of 2024. This is a rapid acceleration, similar to, what we saw, back during 2020 during the pandemic. And so this spike right here, I'm not, it could end up being a positive, who knows? But from what we're seeing right now, as well as a lot of people are a little bit cautious with consumption, I don't think that this is necessarily screaming a positive sign, this rapid acceleration in bank credit. Also interesting as well, when you take a look at Redbook retail sales. So this is a weekly year-over-year percentage rate of change reading for retail sales. It's not the end-all be-all, but it is interesting how this had a pretty decent acceleration it's been accelerating really since the year began and reached a high that we haven't seen since November of last year, pretty much before Christmas time. And if you go back 3 years, I mean, it's pretty much been within this range ever since it started to recover in the summer of 2023. But when you go back even further, the peak that we saw back during November of 2021 was around 21.9%. And then, of course, if you want to, max this out a little bit, it is within, normal range from what we saw from 2017 until the pandemic. So, yeah, this is definitely interesting here to see retail sales continue to accelerate. We already talked about the rebound in commodity prices. So when we're talking about also as well a rebound in this bounce here, I wanted to point out the S&P 500 bullish percent index. And so this doesn't mean that this doesn't showcase whether the S&P 500 is bullish or bearish. It just is talking about, it's showing different momentum trends within the S&P 500. So it takes all the 500 stocks and it says which ones are having a bullish swing, a bullish or bearish swing. And so, this accelerated rapidly from sub 30 all the way up to 64.2%, which is a pretty large bounce. But, the reason why I bring this all the way back to the 2022 bear market is because, we saw something similar throughout the entire bear market where you had just large swings between, 30% and 70%, right? Even though we were technically still in a bear market. And so this is just to say that, these bear market bounces could definitely fake people out. And so I wanted to just bring this up to show this as another data point, not to say, like, hey, look, this is getting back into positive territory. We've definitely bottomed. It's not saying that it's bottomed at all. Taking a look at the Fed now, GDP nowcast from the Atlanta Fed. This continues to showcase negative GDP, Q1 GDP numbers for 2025. Now, just a reminder, the GDP nowcast, I know that it's been in the news a lot over the past month or so, but this isn't necessarily, showing that, okay, this is where GDP is going to go from here. It's just, essentially a clock timer, right? So the analogy that I gave the last time we talked about this was, imagine a runner who's in a race, and the first mile that they start the race, let's say it's like a 1 mile, or let's say it's a, I don't know, a marathon, right? So what is that, 26.2 miles? Let's say for the first mile, they clock it at a 6 mile an hour or a 6-minute mile. What the GDP nowcast would say is like, hey, look, they just ran a 6-minute mile. This is showing that they're going to continue to run a 6-minute mile for the entire marathon. Well, as we know, that's not true. People get tired. Same thing with the GDP nowcast, is that this is just a moment in time. It's not necessarily projecting that this is going to be the number. So, but as we can see with the different clock points here, pretty much all throughout March and April, you can see that there's definitely going to be a slowing in the Q1 numbers, and we'll see, how that is priced in to the markets, because, looking at the calendar for this week, we do get the advanced GDP numbers for Q1 on Wednesday at 8:30 a.m., along with a bunch of other different data points here. So this week is going to be a pretty busy week, not only with the amount of macro data that is going to be coming out, but also as well, we have, big tech earnings as well: Apple, Microsoft, Amazon, Meta, and Eli Lilly. And then we also have some of the big names in transaction processing, like Visa, MasterCard. You have ExxonMobil, Coca-Cola, Chevron, McDonald's. All of these are this week. And so, yeah, big tech earnings, as well as, the Q1 GDP estimates. And then we also have just the normal, first week of the month with labor market data. So we have JOLTS on Tuesday. We have the ADP non-farm payrolls on Wednesday, Challenger job cuts on Thursday, ISM manufacturing PMI on Thursday, construction spending, average hourly earnings, as well as the unemployment rate and non-farm payrolls on Friday. So there's a lot of data this week coming out, as well as, the big tech earnings. So there's definitely plenty of catalysts to go around. And so something that my team and I also like to look at is, how is the market performing heading into these crazy weeks that we could see right now? And seeing that the S&P 500 has bounced into this crazy week on lower volume, that doesn't necessarily scream go all in with your chips right here. So we'll see how this week plays out, but it is definitely interesting here. The week following that, so on May 7th, we have the next FOMC press conference, the next Fed meeting. So yeah, that's not next week, but the following week here. Let me see what day that is specifically. Okay, so that's Wednesday, May 7th. And so, yeah, not next week, but the week after that is where we get the next Fed meeting. And right now, the futures market is forecasting that there's a nearly 91% chance that they remain paused. So, not any type of rate cuts there. And so that brings us to the June 18th Fed meeting, which, as of right now, there's a 58% chance that they cut by just 25 basis points. That still brings it to 4 and 4.25%, which really isn't that much of a cut, if you ask me. And then, going all the way to the December meeting, right now the futures market in the entirety of 2025 has Fed funds by the end of the year being at 3.25 to 3.5%, which is a whole 100 basis points cut from where we're at currently. So the futures market is definitely pricing in some risk there. So we will see. But in the immediate term, only about 25 basis points in cuts from here until June 18th. And so I know that we have Aaron on the call here. Welcome, Aaron. I don't know if you have any other types of points that we want to, mention as well that maybe I did not cover. And then from there, we can go ahead and close it on off from the stream and open it up for discussion within the membership group, all the members that are on the call here. So Aaron, I don't know if you're just listening in. I know that you were traveling today, so if you can't mic in, no worries. But yeah, that's pretty much what I'm seeing heading into this week. Just being very cautious on these types of headlines right here, because again, we've seen this before, like the end of March, and if you were buying into a lot of these headlines towards the end of March, I mean, you got absolutely crushed with an additional, what was that? Before it went down an additional 15%. And again, not saying that it's going to do that again, but this is the exact wrong time to, want to just chase green. All right. Well, we're about 30 minutes in here. For those who are joining us on our social medias, again, we're going to close this off and only open it up to discussion for our members. And so if you want to be part of that discussion, I would highly recommend that you go to the link in my bio. For those on YouTube, it's in the link in the description below. to start your 7-day free trial of our macro investing community. And yeah, if you want to partake in that, I will see you in the call here momentarily. But for those who don't want to participate, no worries. We'll catch you back on Wednesdays, or not Wednesdays, tomorrow, Mondays, live stream at 3:30. Hope you guys have a great rest of your Sunday afternoon here. And yeah, we'll catch you later. Bye.